we're here to kind of talk about the intersection of technology and finance, and there probably hasn't been any moment in our history, in our financial history, where that intersection has been as important as it is now. And of course, Man Group, at least you guys like to boast that you are kind of ahead of everybody on this, kind of the original, I don't know. What,
the OG?
The OG.
That's how we're going to play it from now on. This is the morning thing, the OG of AI. Okay, fair enough.
Well, we'll talk about the evolution of that, though. I mean, a lot of people know Man Group for its quant trading strategies, its systemic strategies, a lot of the programmatic trading. But the evolution of that technology, the evolution of AI, has now sort of infiltrated, for lack of a better word, almost every aspect of what you do.
It has. I think we're talking about AI as a brand new thing. Mm-hmm. I think there's a bit offer in my firm, at least, that it's been around for and being used at Man Group for 10 to 15 years. It depends who's arguing with me at the time, which one I believe. But tech is so much part of the DNA of the organization. It's not just this AI thing that's a brand new thing that suddenly we're all grabbing hold of. We're a quant firm that's been in this space for 35 years. The heritage is deep, and we have used technology throughout the organization. It's part of our DNA, which is an odd thing to say. So it's within our... It's about how you create an operating platform. It's about how you tool up your ops area. You know, we doubled our AUM since 2016. We've not increased our headcount in ops. That's because we have tech. If you are a print of 7 trillion in the market, 21 million trades that you're managing every single year, you need technology. So that isn't just about AI. It's about tech in every part and every aspect of what you do.
You have that in portfolio management, you have that in trading, you have that in a lot of predictive models as well, correct?
Correct.
Do you think your peers are as ingrained, particularly on the portfolio side, in the integration of technology and AI into portfolio management?
I think the reality is that some of this tech is becoming table stakes for every one of us. And that's you know, when I talk and sit around a table with other CEOs, we talk about the tech that we all have, the bit that enables us to be smarter, more efficient, less error-prone, where we take friction out of our organizations. It's a very hard thing to find alpha if you're an active manager. It just is. What you don't want to do is then give that alpha away through your own inefficiency or friction in your own organizations. So do I think that other firms are using this? Yes. Do I think that we are good at this? Yes, I do. You know, I say that half the firm is made up of quants and tech people, developers, data scientists. That makes me feel...
What are they like in real life?
What they like in real life? They're great. I mean, remarkably, they're the most diverse group of people you can get. There's this sense that, and we talk about this a little bit, I have a big discretionary investment team as well. And in the old days, I used to talk about people being... The people who used to sit at the front of the class and the people who used to sit at the back of the class. There's a bit of that, but the reality is there's difference across the entirety of Man Group. We have this program called Mindset Man, which we started actually through COVID, which was about getting people to talk about what they do outside of Man Group. I can't tell you the ability for people to be talking about how they've won national championships in aeroplane model design and blah, all the way through to they're the best wine tasters in the world versus how quickly you can do a Rubik's Cube. I can do none of those things.
Okay.
But
do you have a talent?
Very few talents. I tried karaoke for the first time last week. That's not my talent either. There you go, though.
Yeah. But part of your talent, though, is kind of bringing all this together. I mean, your background in risk compliance, I would assume would have some transfer to what you're doing today, or did this kind of just completely hit you out of the blue?
I think what I benefited from has been a career where I have found myself navigating different challenges and that the market's thrown up, that organizations have thrown up. That's quite a privilege, actually. But I sit across the table sometimes from people who haven't seen a credit crisis. I have. Who haven't seen market dislocations quite badly, well, I have, or haven't seen a version of how Russia has already devalued once or twice before. So my experience through navigating those things have been incredibly valuable. I think the other piece is I have run large chunks of Man Group, be it trading or be it ESG or be it our solutions business. And that evolution has been very, very useful. So I have the benefit of seeing the organisation and financial services through many different lenses, and that has stood me in very good stead.
You talk a lot about how the technology has increased productivity.
Yes.
When we talk about the new applications of AI, and I'm not just talking about the front-facing chatbots that we all know about, but really kind of the stuff that's really deep into the background, how additive is that to your bottom line?
So AI is exciting, and it's an efficiency. When I talk about how we use technology, artificial intelligence, any sort, NLP, large language models, it can move through what it is to be more efficient in data research, in how we execute transactions or trades more generally. It is how we put transactions and how we put content together. It's around predictive models, be it in financial predictions or in ESG. It's any number of these pieces of the puzzle. It's about the fact that we have sentiment analysis, that we're able to deploy technology in a way that enables our discretionary traders to operate more efficiently and effectively in their thesis, or in quant, as we go out to more markets, more data sources, to be able to see whether we can find more alpha, which is ultimately for the benefit of our clients.
I don't want to alarm you, but they just put your 5-year stock price
I just saw
behind
that.
you, so just look away. It's not bad over 5 years.
It's not too bad.
When we talk about sort of what the next 5 years or 10 years are under the leadership of Robyn Grew, how much further can you deploy this technology in AI? I mean, I know it's there, but what's the next evolution of it?
I think, you're right. This evolution of technology is just the next one. There'll be a one after this and the one after that. And we'll be, I think, adopters of those things within reason and within risk measure to make us smarter. But what we're really after is ensuring that we continue to grow content and that we have relevance to allocators, to our clients. This is a space where clients are looking for more from fewer managers. They're looking for greater content. They're looking for more customized solutions. When you look at Man's AUM today, 2/3 of our AUM is now in some form of customization. When you look at the clients that we have, the top 25% of our clients are in 4 or more of our strategies. That's because clients want more customized solutions to the real challenges they're facing. These markets are difficult to navigate. The world in which we're operating is tumultuous. It is tricky. And so when you are sitting down with clients, when you're working with them, you want to be answering the questions they have, the challenges they have, working through those challenges with them. And so for me, it's about growing content and capability. It's about growing and being sure that we are still relevant and that we're at the table with clients as their partners to navigate these market cycles, cycles that we haven't seen as dramatically for the prior 10 years, where we had a much more passive environment where cash was free.
Well, I mean, you think about the cycle we're in now, which some people would say is relatively unprecedented, certainly in the modern era. I mean, how do you, when you talk about AI and the use of data and other things that go into that, you're looking backwards, right? You're taking past events and trying to correlate them to, at least for what today seems almost unprecedented. How do you square that circle?
Well, you're not just doing that. So you're also looking for new sources, new data streams. You're looking for the ability to, as I said, look at NLP, look at sentiment analysis, look at the ability for my discretionary investors to be able to look at much broader swathes of information, to be much smarter about their investment thesis. So it isn't just a backward look at market behaviors, although that's always interesting to do, especially if you're running trend momentum strategies. But it's also about deploying technology to be just better at what you do and better at finding sources of investment capability, and then being able to test them in an uncorrelated way. You know, more data doesn't mean uncorrelated. You want orthogonal content. You want content that is able to perform through different market cycles. So it's not just about a backward look for predictive modeling. It's about using technology and using AI capability to find new, different, uncorrelated sources of investment that you can deploy at scale and in a way that can be customized so that your clients are getting answers to the challenges they're facing. Romaine, we're not in a position where people have a blank piece of paper. We're not at school in that sense. We're not. What is your ideal portfolio today? Let's start with $100 and invest that. That isn't where we're at. We're at a place where allocators already have portfolios. And now they're trying to think about, do those portfolios do the best they can do in the environments that we're navigating? Are they really going to protect them in a recession, disinflation, deflation? What does it mean globally? Is the US away? How is their portfolio invested internationally? What does that mean? How much exposure have they got in private equity, which means they don't have the liquidity? What's their liquidity profile? What's their duration risk? How do we manage maturity? We don't start at a blank piece of paper. And that's, I think, why customization is more and more important, because you're on a journey with allocators to help them rebalance and to rethink their portfolio through time and to be responsive to market cycles. So technology, let me circle us back round. Technology and AI is part of us being better at what we're doing. What you're not hearing me saying is that AI is suddenly going to make investment decisions. What I'm saying is it's going to make us better and smarter at all of the underlying capability. We will deploy technology to make us better at what we do, rather than to replace what we do.
So less a replacement, more of a tool.
Correct.
For your managers. Do they understand that?
Yes. And when you have half the firm that are technologists, developers, and quants, why do I sit a little bit easier on this chair? Or why do I sleep a little bit easier at night? Is because the great thing about having that capability in your organization is they know what these tools can do, and they also know what they don't do, what they can't do. So this is back to talent and technology. It's back to having skilled operators. The smart people will know the risks of deploying technology as much as they know the benefits of it.
Where is your talent pool coming from right now, the new talent pool?
That's a great question.
Thank you.
You're welcome. We can do this all day. So where does it come from? It comes from any number of different sources. Actually, it can come from, for sure, other houses. It can come from new graduates. It can come through lateral places and hires. The question I sometimes get asked is whether we have trouble hiring tech and developers and quants. And the answer is we don't. We have thousands and thousands of applicants, actually, for opportunities we have. And that's great. Did we lose some people into FANG? I don't know whether you say FANG with two N's. I don't know how to emphasize the double N, but FANG. Yes, we did for a little bit, and then people came back. They came back because the use case for people joining Man Group is we have real-world issues, which are really tricky, where you get to work in an organization where you're part of solving that, where those issues continuously change. I love these charts. Where these issues continuously change, and where we need the smartest and the brightest minds to be part of that. We offer an organization that believes in open architecture, and so we give access to the greatest developers across the world in collaboration. When you look at this, when you look at our GitHub ratings, you'll find that we have the highest ratings for an asset manager, sort of double the ratings of the largest US banks. Why is that? Because we are willing to share and have an open architected solution. So we don't have a shortage of applicants, and we have people who are excited about making a real difference in the real world.
It's still competitive, though, for those applicants, and you're not just going up against finance companies, you're going up against pure play tech companies.
Correct.
A lot of things in between now.
Correct.
Yeah. So I assume, you got to, make the checks a little larger, right?
Well,
yeah.
I think with all of us, we work in this industry because there's a degree of financial reward in it. But I think we're all crazy if we think we stay in our roles, or we create firms which are only about money. We create cultures that are great. We provide people with platforms and opportunities to be the very best they can be. We invest in them. This is everybody's sitting down, so few, but I have lawyers who are coding. Some of the biggest Python users in our organization sit in our operations and back office. It's about that. It's about skilling the entire organization up, and it's about giving some of the brightest and smartest tech developers, quants, the opportunity to be the very best they can be. that's exciting. And if you do so in a way that gives them the tool set and the freedom to collaborate, it's powerful. It's an extraordinary tool.
When we talk about this idea of recruiting more talent and obviously building that talent internally and so they can rise up here, I know it's hard to know what 20 years down the road is going to be, what technology is going to look like, what the world of finance is going to look like, but how do you prepare them for that? Because I'm sure that when you started your career, you probably didn't envision the outsized role that tech has in your job right now.
I think that's right. In some ways, predicting 20 years from now is probably a fool's errand. I mean,
you don't have any machine learning models that can do that for you?
I'm not going to rely on those machine learning models to predict 20 years from now. There's too much that's going to change. I think it's about being nimble. When you're a 2,000 strong active investment manager, we benefit from being nimble and dynamic. Actually, we make sure that we try to continue that level of flexibility. We're not that slow-moving juggernaut. And so that opportunity to be dynamic, that opportunity to take advantage of new technologies or new opportunities, that's what it's about. And you hear me say, we will go where the capital markets are, we will go where we can find alpha, we will go where we can service our clients to the best that we can do that. That's what drives us. We have a sole delivery, right? We come into work every day for one thing.
How do you maintain, though, that dynamism as you grow? I mean, you say, okay, about 2,000 employees. I know that's small relative to some other giants, but that's still pretty large. We just had your assets under management there. You're approaching, I think, close to 200 billion now, and presumably that's going to continue to grow. That's going to have some effect here on that dynamism and flexibility, does it not?
I think it's, you have to work hard at it, is the short answer. You have to be very clear that what you're not trying to do is create something that's too intransigent. It's the challenge and the check that we have within the organization. But you can grow assets and be scalable and not necessarily grow people. I mean, I think that's one of the tools. That back to that operations piece, you can double your AUM and not increase your back office. It's about having highly skilled people that are really about focusing on alpha delivery. That's much more important. Do we grow? Yes. But I'm much more about we have to focus on culture and be dynamic in the process.
You want an audience question, Romaine?
I don't know. Do I want an audience question, Romaine?
I don't know who asked it, but I'm going to ask it anyway for you. A question coming from the audience is saying that some say, I don't know who some is, but some say quant investment is not working as well anymore because of interference from the Fed to keep lowering rates when in theory we are not in an extreme situation anymore. What do you think? Question mark.
That's an interesting question. I think the reality is that there isn't one quant model. I mean, that's the suggestion that somehow quant investing is a one-thing thing. It isn't. It's multiple things, and it does multiple different things, whether it's in a tail protect environment, whether it's in a risk management, risk premium piece where you're managing macro environments, whether it's momentum on a longer 30-year look, whether it's in trend, which can be an 8-week look. So it isn't one thing. It's about the dynamic nature of it. And in equities, complete different thing again. Remember, we have both quant and a macro in that interest rate environment, but we also are looking at quant modeling within equities. And we have an entire business that's driven through that pace, along with long-short content that sits in the quant environment. So not one thing. Markets are going to have interference. We have the most extraordinary geopolitical environment at the moment. That also creates market volatility and uncertainty. So I think it's about having different content, different products that are executed through different means.
That uncertainty, though, I mean, I would assume to a certain extent that could be a benefit. I mean, you mentioned the elections. Obviously, we have two pretty critical ones coming up overseas, and of course a big one here in the U.S. I don't know if you're going to stick around for that, but I would assume that based on what you do, or at least what the folks under you do, that does create opportunity, right?
I think it creates volatility, and in any environment where you have active investment management, volatility and dispersion is where you want to lean in as an active investment manager. It's back to that point about portfolio construction. The last 10 years, let's take out last year, but the last 10 years prior to that, if you were an asset holder, you made money. I mean, you might have had risk-adjusted assets, but you'd have made money. You're not in that environment anymore. The minute you have volatility and dispersion, you are going to require a portfolio that is able to navigate different market cycles. And that means you're going to have parts of your portfolio that will perform and you will have parts of your portfolio that will not perform. And that is the nature of a hedged and a diversified content portfolio. The one thing I can tell you in every conversation with clients that I've had over the last 18 months is an appreciation for diversification, an appreciation for liquidity and duration, and an appreciation for the fact that the world is not going to be as predictable as it had been prior to that.